Hi everybody, Tarryn here, and welcome to the fourth in our series of live webinars as we take you through the Finance for Non-Finance Professionals course. Today we are going to be dealing with project investment appraisal. So quite a long sounding name, and let's just sort of jump into it and see exactly what this entails. So while we have a look at our syllabus for this module, there is going to be a poll that's put up on screen that pertains to the prior module. So have a look and see if you are able to answer that question and whether you're kind of on track with your learning. So project investment appraisal is really about assessing why it's important to undertake this process, what we can do in terms of assessing the different risks of a potential project, how inflation and other financing costs impact upon the project, and we sort of compare different appraisal methods to each other. So we cover pretty much all of what is required for this module 4, but obviously following on from this webinar, it would be great for you to read through the notes that are in the online environment, and please do email through any questions that you may have as you're going through this material. Right, so what is project investment appraisal? Sort of fancy sounding name. And really what it means is that when a business, and this may be a startup business or it may be an existing operation, when they plan to grow and to expand their business operations, they often need to invest in a new something. And that new something is a new project, and that's how we class it. It could be a new factory, it could be a new piece of machinery. And this is the area of finance where quite often non-financial people who are perhaps in an engineering type role tend to get involved. If we think we're working for a big, let's say an electricity utility company, and they are trying to assess whether to build a new power plant or to make extensions to an existing plant, that would be a big project. And they would have to assess the viability of this project before they go and commit the funds to it. So they need to figure out whether this is a good idea, whether this is going to add value to the business as a whole from a financial perspective. And you also need to assess the project viability given the resources that may be available, and those may be limited. You know, we don't have an endless budget for projects. We can't just do new things forever. We've got to have a sort of a cost-benefit analysis, because there will be a limit on money and there will also be a limit on human expertise or human capital to actually undertake the project. So we would clearly need to assess whether we as a business have sufficient cash on hand to undertake a big expansionary work. And quite often a business may not have sufficient cash on hand, and they may have to go out and borrow money in order to finance a new project. Within a big company, and if any of you have worked in a big corporate environment, you will know that within the sort of corporate politics, each division within a big company tends to have its own pet projects, its own things that it really wants to spend money on because that division believes that it's really business critical and important and new. And so you would see this particularly in sort of a research and development type environment. Think about a big pharmaceutical company, and each division that's sort of focused on different drugs may say, you know, investing in this new drug trial is really important and really critical, and one division may compete against another for resources to finance and to fund their pet project. The risk aversion of the business sort of speaks to how much the management and the owners want to expose themselves to an uncertain future. When we undertake a project, when we go through a big planning process and we try as best as possible to capture all the potential future cash flows, But we may not get it right, and economic conditions may change. It may cost us a whole lot more than we anticipated. There could be all sorts of things that sort of go wrong that impact on what we thought the future was going to be and mean that it's less rosy than we would have liked. And so the risk aversion is sort of the willingness of the owners and the management to undertake a project with an uncertain future potential payoff. Some companies are really risk-taking and risk-seeking even, and they would happily invest in new sort of moonshot type projects, whereas other companies may be very conservative and may want to think very carefully before allocating funds for expansion. And the risk aversion sort of fits together a little bit with requirements for a fast payback or high returns. If you've got a company that is happy to take on risk and happy to sort of chase these sort of out there moonshot type projects, they may want to be really compensated for taking on that risk. So that is the high return element of the project. The project has got to deliver returns into the business. Some companies may say, you know, we're prepared to allocate some of our cash resources, but we want the project to generate and pay back that cash very quickly. We don't want our cash tied up in this project for a long period of time. So aside from the project itself and the viability of the project itself, that project has to fit within a bigger organization, and that bigger organization will have its own risk aversion, its own resources, its own degree of internal competition that needs to be managed. So what project appraisal is trying to do is to essentially give management and owners the tools with which to evaluate these potential avenues for growth and expansion. The most simple first pass or first screen evaluation when we are considering a new project is something called a payback period. So payback period appraisal. It's really in many senses, a back of the envelope type computation that just tries to figure out which of our potential projects, and let's say we're assessing a number of them, which of these potential projects has the shortest payback period. So in other words, which project generates cash really quickly that can pay back that initial investment. So we'll have a look at an example, and this will make it sort of more real and easier to understand. But there are flaws with the payback period. It's a good first pass. It's kind of quick and easy to do. You don't need anything complicated to figure out the payback period. In fact, most times you can sort of do it in your head. But it ignores some of the more complicated issues like inflation and this concept of time value of money, which we will touch on in a bit. If you are comparing projects and you've undertaken a sort of payback period methodology and appraisal process, you are likely to select the project with the shortest payback period. The quicker you can recoup your money, recoup the spending on the project, the less risky the project is. So let's look through and work through an example. These figures are actually available in the online environment. You'll see there's a document that you can download so that you can go and work through this yourself and have a look at these numbers. But essentially what we've got are 3 different potential projects. So project A, project B, and project C. And we're given a whole lot of information about these projects. And this is what the engineering department or the manufacturing department or somebody with a technical expertise would sort of go away and gather all of this information together. In this instance, we're assuming that we're going to buy a new piece of equipment, and there is a cost to that equipment, and we refer to that as the capital cost of the new equipment. It could be the capital cost of a project as a whole, one piece of machinery, one factory, one new branch, one new division. Doesn't matter how we define it, but there is an initial cost, the initial capital cost that will have to be incurred when we kick off this project. When we're dealing with assets, if we remember from some of the early modules, and this is an accounting term, we can depreciate assets over their working useful life, which means that we can sort of account for the usage of the asset as we go. So when we're dealing with assets, we've got to have some indication of how many years we can put this asset to work for, or how many years we expect the new division to operate for, or the new piece of equipment or machinery. So that is what we've got there. What we have been given is, in each of these 5 years, is a profit before depreciation. And we'll touch on why before depreciation is important in a sec, but for the moment, just considering a payback period, what we can see is that for project A, we initially, at time 0, we have to spend £500. Now this could be £500,000 or £500 million, it doesn't really matter. We've then got flows coming back into us. So this flows away. We pay that out of our resources, £500. In year 1, £300 comes back in. In year 2, for project A, £200 comes back in. And then in years 3, 4, and 5, we get £10 per year coming back in. What we do in a payback period, and you'll see why it is just a sort of a quick and dirty methodology, is we say, okay, well, in year 0, initially, we're down £500. So that's a minus £500. In year 1, £300 comes in. So that's plus £300. If we initially were down 500 and now we're up 300, what have we got? Well, we're still down 200. And I hope this is making sense to everybody. It's sort of a running total. So you started at minus 500, 300 comes in, so now you're at minus 200 in year 1. In year 2, another 200 comes in again. So now your minus 200 is completely paid off or paid back by your year 2's cash coming through. So now we're at 0. So can you see that in years 1 and 2, enough money came in to pay back what we had to spend in year 0 or our initial amount? And that means that project A paid us back in 2 years. If we have a look now at project B as an example, and we can see that project B is more expensive, it costs us £1,000, but let's have a look at our flows. So in year 1, we get £200 from project B. So if you keep a sort of running total in your head, you will know we're still down £800. So my writing is quite horrible there. So we spent 1,000, 1,000 went out, we've got 200 back, we're still down 800. In year 2, we get another 300 in. So now we're down 500. And there it is. In year 3, we get another 200 in. So now we are down 300. Okay, so we still haven't paid back. The cumulative of our year 1, 2, and 3 still hasn't paid back our initial £1,000. In year 4, we get 200 in. So now, still not paid back, we're now down £100. And finally, in year 5, we get 500 in, and that pays back, finishes paying back our project. So for project B, it's going to take us 5 years to recoup that initial £1,000 that we spent. And if we could go through the same exercise for project C, and we'd see that in year 1, we're down 800. In year 2, we're down 500, which is the same as project B. In year 3, we were down 500 in year 2, and we get 300 coming in year 3. So now we're down 200. And in year 4, we get 300 in, which settles our project. So what we can see is that by doing this sort of payback period, which keeps a running sum of whether we have paid back our initial amount, we can see that for project A, it took us 2 years. For project B, it took us 5 years. And for project C, it took us 4 years. So without considering anything else about these projects, our initial first pass says, well, project A definitely looks interesting. We pay back our initial sum quickly. And if I had to choose between project B and project C, I would pick project C because it pays back more quickly than project B. And that is the payback method. So nothing more than a little bit of addition and subtraction to figure out which year you have paid your initial capital amount. Okay, so let's have a look at a few additional metrics because we've run through a payback appraisal method. Can you see that in the table, and now we're just looking at project A as a snapshot, can you see that what they very helpfully gave to us in this worked example was profit before depreciation? And when we are evaluating projects and we're undertaking project appraisals, we actually focus on cash only rather than our accounting earnings. And we recall that depreciation, as we discussed a moment ago, is the usage expense, the wear and tear of putting that equipment to use over its lifetime. There is no cash that actually flows out when we account for depreciation expense. So we have to exclude it from our appraisal evaluation. We have to strip out anything that is not a non-cash item. Sorry, there was a real double negative going there. I confused myself. We only worry about cash. Depreciation is a non-cash item. We exclude it. This table helpfully did that work for us, but it's just something to be aware of if you're looking at a project appraisal schedule in your organization. We've now got a few additional bits of information that show up here, and let's discuss those. 2 items here, disposal costs and disposal value. What quite often happens is we buy a piece of equipment and we put it to use and it manufactures our widgets and we're all happy, and it comes to the end of that machine's life. And we decide we're going to sell it, and there's somebody out there that is prepared to buy it. So that is the disposal value of the machine. So it may not now be the £500, maybe somebody would just give us £25 for it. But that's okay. That £25, the disposal value of our piece of equipment, will actually flow back into us. When we talk about disposal costs, this quite often happens in perhaps a big mining operation where they have been working a mine for many years, and now that mine has come to the end of its life and is shutting down, and there are actually costs associated with shutting down the mine, making it safe, putting back the fauna and flora that was perhaps disturbed, cleaning water, filtering soil. Those would all be costs associated with coming to the end of the project, and those would flow out at the end of the project's lifetime. We also have this concept of total return on investment. And in this instance, what it means is looking at what we get over the life of the project. So all of those year 1, 2, 3, 4, 5 cash flows coming in. We know that if we had disposal costs to pay, those would flow out. So we subtract our disposal costs. And we know that if there was some scrapping value, some value that we could recoup at the end of that project's lifetime, that disposal value would flow into us. So we add that in. in this instance for project A, we've got no disposal costs and no disposal value. And that gives us sort of a cumulative of £530. And that is the total return that we've made. We then can work out what the profit on our investment is. And we do that by deducting the capital cost, that initial time zero cost of our piece of equipment, from our total return. So you can see that our total return, when we added together our cash flows and we deducted any disposal costs and we added in any disposal proceeds that we got, disposal value, our total return was £530. We know that that piece of equipment for project A cost us £500, 530, subtract the 500, leaves us with £30. £30 or £30,000 or £30 million may not be such a helpful number. What we might want to do is express this as a percentage of that initial capital cost. And that's what the total net profit percentage does. It says our profit on our investment divided by our capital cost. And I'm just going to check. Mark has asked a question. Yes, Mark, return on investment capital is what Mark is asking. We can see that as being fairly equivalent to our total net profit as a percentage of investment, because our investment capital in this case would be the £500. And what did we make on that £500? Thanks for your question, Mark. Okay, so with these details in mind, let's now have a look at an alternative project appraisal method. And this project appraisal method is known as the average returns appraisal. So we've dealt with a payback appraisal methodology, which was just sort of a quick and dirty check to see how quickly we could recoup our initial capital cost. Now what we're going to do is look at an average returns appraisal. And the name sort of gives it away. What we've got to do is figure out what our average coming into us is over the life of the project. For project A, our average return is 106. Now, how did I get to that number? What I did is I added 300 plus 200 plus 10 plus 10 plus 10 and divided it by the number of years. In this instance, 5 years. So what we've got, when we added these together, we called it our total return of investment, which was 530. And we divide it by the number of years to see on average what we're getting in each of those years. And for project A, we're on average getting in £106 per year. And we do that same exercise for project B and project C. And we can see that for project B and C, on average, we're getting in £280 per year, because we added up all of our flows over the project lifespan and divided it by the project life. So that addition, and it's the same number for project B and C, is £1,400. We add all of that up, £1,400, and we divide it by the project life, and that gives us on average £280 coming in per year. What this average return number allows us to do is get what is called an average rate of return. And we divide our average return, so what we get in per year on average, by the capital cost of our equipment. So in the instance of project A, we would be dividing 106 by 500 and thinking of that in percentage terms, and we would get 21% as our average rate of return on the project. For project B and C, we get the same number because we had the same total return on investment, the same average return, and the same capital cost for project B and C of £1,000 per project. So we get an average rate of return for B and C of 28%. So now what we can start doing is thinking about our average return appraisal together with our payback method appraisal. And if we keep all of that information in our heads, we know that project A paid back quite quickly in 2 years, and it made us 21% on an average basis. When we were considering projects B and C in our payback method, we chose project C because it paid us back in 4 years, whereas project B took 5 years. So given that projects B and C give us the same average rate of return, we are absolutely going to choose project C over project B. Same rate of return, faster payback. So we're starting to build up our arsenal of what we can use to evaluate these different projects. Now, in a payback method and in an average rate of return method, there is unfortunately a flaw that becomes increasingly pronounced if we are dealing with a project with a long lifetime. And that flaw is two things, but principally it's inflation. And what inflation, we can think about it as essentially eroding the value of our money over time. And I've put some inflation data down, perhaps in metrics that will be more familiar to everybody. If we were standing in 1914, you could walk into a pub and have a pint of beer for 1 pence. And I'm sure everybody would be cheering at that point, perhaps not your livers. On average in 2017, and maybe you have more accurate, up-to-date data, maybe you were down at the pub at lunchtime or plan to hit the pub after this webinar, but on average you're paying just over £3 for a pint of beer in 2017. So what we can see is that our £100 that we had in 1914 would have bought us a lot of beer. Our £100 in 2017 probably still buys us a fair amount of beer, but not nearly as many pints. So that is the effects of inflation at work. Things become more expensive, prices go up. That £100 doesn't buy you as big a basket of goods anymore. And so when we consider project appraisal, if we're dealing with a project that's making cash flows 15 years into the future, we know that that cash flow 15 years away doesn't buy us the same goods as that equivalent cash flow today. So we've got to make some sort of adjustment for this inflation and for the fact that essentially money is eroding in value over time. The sort of broad concept of this is something called time value of money. And you would rather have cash today than cash in the future, unless you are rewarded in some way for that cash in the future. If somebody's offering you £100 today or £100 in 2 years' time, you take the £100 today, always. What also happens is that often a business may not have sufficient cash to pay for the project. That capital cost may be too big a number and they simply do not have the cash. So they finance the project, which means that they go and borrow money from investors, from a bank, to pay for the project over time. That project's got to generate sufficient cash flows and sufficient returns to cover and to account for the financing cost and to account for inflation. So we've got to make an adjustment. We've got to say we know that £100 in 2 years' time is not equivalent to £100 today. So how do we adjust? How do we discount our future cash flow so that it better reflects the value that we could buy with it today? Some of you may be really interested in the maths of this. And if you are, I really would suggest that you just do a little bit of Google searching. There are plenty of resources available online that will explain time value of money and how that applies to capital budgeting. But it is not the intention to sort of throw anybody into the deep end with some heavy duty maths. So we've got a little cheat table of discount factors that are going to allow us to adjust our future cash flows, to discount them, to reduce them, so that we can get a sense of what the equivalent flow would be in today's money. Let's have a look at how we do that. So here is our table of discount factors. And it looks a little bit scary, but don't worry too much about it. Again, you know, a discount factor table is actually very easily available online, so it would be certainly something that you could pick up if you were going to go through this exercise. What you have to decide is what rate you are discounting at. And we are just going to make an assumption that for project A, we are going to discount at 5%. Now you can think of that 5% as perhaps the inflation rate or perhaps the cost of your financing. So we could say, and dependent on what market we're in, 5% may be perfectly acceptable inflation rate. Perhaps if we're in the US, that would be a little high, and perhaps in an emerging market that might be a little low. But we would pick some appropriate rate for our market, taking into account the inflationary environment that we're operating in and taking into account the costs of financing that we may need to incur. And what we would do is we would say in year one. Now remember, we're in year naught. So we stand, let's say, on the 1st of January 2017, and we buy our new pieces of equipment for £500. Year one means we are no longer on the 1st of January 2017. We've jumped forward a year. We're on the 1st of January 2018. And our £300 that we get in 2018 is not quite the same as £300 in 2017. So we've got to reduce it, we've got to discount it. And the same as when we're standing in year two, which could now be the 1st of January 2019, our £200 of inflow is not quite the same as we would have were we standing in 2017. So again, we've got to reduce it. And what we do is we pick up a discount factor from our table. And we do this by finding the intersection between the rate that we're using and the number of years away that the cash flow occurs. We have decided to use a 5% rate. So we are very focused on this 5% column. For year one, we are now 1 year into the future. We pick our year one row and we find the intersection between our year and our rate, which for year one gives us a discount factor of 0.9524. And what we do is we take that discount factor and we multiply our cash flow by the discount factor. And what that tells us is that £300 1 year away is actually equivalent to £285.71 today. And we do the same exercise for year two. So now we're looking at year two. We're still focused on our 5% column because that's what we're discounting at. And there we can see our discount factor at the intersection between 5% and year two is 0.9070. And we multiply our £200 that we receive in year two by our discount factor. And what we see is that £200 2 years away is actually worth £181.41 today. And we go through this exercise for all our future cash flows, moving down a row each time to pick up the appropriate discount factor given how many years into the future our cash flow is occurring. And what these are our future cash flows all in today's money. And we call that a present value. So today, the present, how much are those future cash flows worth? That is our present value of our future cash flows. And then what we do is we add them all together to get a cumulative present value of all of those future cash flows. And we get £491.82. What we have to do next is deduct that £500 from the cumulative present value, the sum of all our future cash flows. And what we see is that when we discount at 5%, that we actually have a negative net present value. So we've done 491.82, the sum of all our present values, and we've subtracted our capital cost, our outflow of £500, and we end up with a negative number. At any point where you get a negative net present value, the project is not worth doing. You always want to have a positive net present value. That is like an absolutely crucial determinant in deciding whether to undertake a project or not. Now, that net present value is very dependent on your expectation of your future cash flows, and it is very dependent on the discount rate that you've used. So if you're undertaking this exercise, you need to spend time making sure that your future cash flow expectations are as right as you can make them. And you need to think very carefully about what discount rate you use. Is it appropriate for the inflationary environment? Is it appropriate given my financing costs? Because you can only accept projects where the net present value is a positive number, and ideally, if you were comparing one project versus another, you would pick the project with the highest net present value. If you pick projects with a positive net present value, they add to the value of your entity as a whole. This project would actually cause the company to lose value, and we would never undertake it, even though when we did our back of the envelope computation, we saw that it had a fast payback period of 2 years, and even though on an average return appraisal basis, it made us 21%, which seemed like a pretty decent number. As soon as we get a little bit more real world about this and include those time value of money effects, that include those inflationary effects, what we see is that project A is a non-starter. It erodes the value of our business, and we would never undertake it. Within the online environment, you will find that this document that gives you the details for project A, B, and C. And what would be really good is to go and undertake this exercise for projects B and C and determine whether there is one that is the clear standout winner. So evaluate the net present value of projects B and see which one has the highest net present value. And then together with your information about payback periods, and together with your information about average returns, you will be in a good position to make a determination on which project to proceed with. Right, so by way of recap, understanding how to appraise a project is very important, and particularly when we are undertaking a big capital intensive, so in other words, expensive project that's going to happen over a long period of time. We need to know before we start committing time and money whether this is going to actually benefit our organization. As a quick first pass, we can undertake a payback period assessment. It is quick to do. There's no complicated maths that's going on in there. What you may have noticed when we undertook that payback period, when we were looking at Project A, and we saw that Project A paid back its £500 capital outflow in 2 years. We got to the answer 2 years and we stopped. We ignored the cash flows that came after that 2-year point. In the same way, when we were looking at Project C, we discovered that by year 4, Project C had paid back its initial capital sum of £1,000, and then we stopped. We didn't look at any flows that came after that payback period. So that is also one of the flaws of a payback period appraisal methodology. So a kind of quick first pass, back of the envelope, let's just get a sense of what kind of duration we're looking at to recoup that capital sum. When we consider an average rate of return, it's also pretty quick. Yeah, we've got our future cash flows, we add them all together, we divide them by the number of years of the project life to get an average flow coming in per year, and we assess that average flow relative to the initial capital outflow. So in this instance, we are actually considering the cash flows across the whole life of the project, as opposed to the payback period, which stops worrying about future cash flows the minute we've hit that payback level. But that average rate of return still ignores inflation or finance costs. So it is still flawed, albeit slightly better than the payback period appraisal methodology. If you really want to do the job properly, then really we have to undertake a net present value appraisal methodology. Now, this is without doubt computationally more involved. Those functions to discount are actually all available in Excel. So you would be able to do this sort of in an Excel environment, and typically project appraisal actually is done on Excel spreadsheets. You do, when you are undertaking a net present value method, it really becomes very important what discount rate you choose to apply to your future cash flows. It has a very material impact on what you find as your net present value. So we do consider the cash flows across the full life of the project. And by undertaking a net present value computation, we do include those effects of financing and inflation on those project cash flows. And we will then determine a net present value, which sums together the present value of all our future cash flows and deducts our initial capital cost. And we are absolutely looking for a positive number there. And if we're comparing one project versus another, we would always choose the project with the highest net present value. Just in terms of notation, that is often shortened to NPV. So if you see an NPV number, it's a net present value. And that really brings us to the end of our module on project investment appraisal. There are some sort of computationally challenging bits to it. So if anybody has any questions, I would love to answer them. And perhaps some of you have been in an environment and or an operation where you have had to consider whether you're going to undertake a project or not. And this is the process that you would go through. Once your team have determined and modeled and mapped out what those future cash flows might look like, you would then undertake a number of these sort of methodologies to determine their project appraisal and which one you should pick. Mark, you're saying I have referenced online documents twice. Where are those templates? Sure. So if you look within the online module for module 4, I think towards the bottom of that content, there is a sort of a for practice type document. There is a Word document there that if you click the link, it should download and open up. It's sort of something to practice. Scroll all the way down to the end of the section and you should find it. If you're still having trouble, please do email the team and I'm sure they'd be very happy to shoot that link across to you or send you the document. Anybody have any other questions on project investment appraisal? Hopefully now, when you go through the online content, some of this will make a little bit more sense as a second pass. But it would be great if somebody could share an example of where their business has had to decide on whether to undertake a project or not. So Mark has asked a question and he says, with the inflation rate in the NPV model, why is this considered a discount rate, or am I confusing things? Yeah, Mark, some of the terminology can be confusing because we would refer to that inflation rate or discount rate or financing rate, or if we're really sort of getting into some heavy duty corporate finance, we would actually call it a weighted average cost of capital, which sounds quite arduous. But it's essentially what we're trying to do is to say, we know that these future cash flows aren't worth the same as our money today. How do we figure out how to reduce that future cash flow to give us a sense of today's purchasing power? So it is tied to time value, which is why, in fact, I'm going to go back to that sheet and have a look at this table. Can you see that as we move through time at our 5% rate, our discount factor gets smaller and smaller? So in year 5 at a 5% rate, we're multiplying through by 0.78. And if any of you sort of think of that in percentage terms, what we're saying is that money 5 years out is actually only worth 78% of money today. Money 1 year out is worth around 95% of money today. So Mark, we can call this number sort of a variety of things. In the content for this course, it's sort of referred to as an inflation rate. So in other words, saying we're losing purchasing power. So we've got to reduce our cash flows for that reduction in purchasing power. But in other sort of corporate finance environments, as I say, this would likely be called a finance rate, or when you really get into corporate finance, it's called a WACC, which stands for weighted average cost of capital, which really starts to speak to how is the business financing, paying for this initial capital cost. Okay, Christine, that's a great question. Christine is saying NPV is more accurate to calculate the return. How do you calculate the factor of disposal, cost, and value? So great question, Christine. So let's assume that in year 5, we know that for project A, we make that £10. We would have additional cash flows in year 5. In year 5, it may cost us £2 to do a bit of cleanup and wind up of our factory, and we may get, let's call it, another £5 in because we've sold our piece of equipment. What we would do is also find the present value of those additional cash flows. We could lump it all into the final year 5 and say year 5 is plus 10, which we made from our piece of equipment, minus 2, because that's what's going to cost us to clean up, so that would then be plus 8, and we would perhaps get 5 because we'd sold our piece of equipment, which would leave us with plus 13. So that would end up with a sort of plus 13 for year 5 after taking disposal costs and disposal value into account. We would still discount this final year of cash flow at our appropriate discount rate, which for year 5 at a 5% discount value would be to multiply it through by 0.7835, and then we would get a different number here. So in fact, let me see if I can quickly haul out my phone calculator and we can actually work it out. So let's say it's 13 multiplied by 0.7835 would give us 10.1, and I'll round up, 10.19. Okay, and so we would then, instead of adding 7.84 in there, we would add 10.19, which takes into account our disposal proceeds and our disposal costs and would change the cumulative present value of our investment. I hope that answers your question, Christine. What it is about keeping track of the cash flows and the year in which they occur, and then discounting that sort of net proceeds altogether. Great stuff. So Mark, you're saying, how is the inflation rate or the WACC determined? Well, that is perhaps a question for another day. When we are dealing with inflation rate, we are going to have to come up with some sort of forecast. And there are sort of many ways in economics in which you can do this. You can also have a look at what is called the yield curve, which gives us a sense of the interest rate of government bonds going out into the future. And quite often, inflation is some margin above or below that yield curve, so we can determine a rate on that basis. So it's sort of like the market, the bond market or the fixed income market, giving us an inflation expectation. If any of you even perhaps read The Economist magazine, towards the back of The Economist, they often have macroeconomic indicators, and they often give you an expected inflation rate. But at the end of the day, you're going to have to make some sort of forecast on what that number should be. When we're dealing with the WACC, the weighted average cost of capital for a company, it is a function of the cost of their equity on their balance sheet and the cost of their debt on the balance sheet. And those two numbers can also change over time, but we could think about it from the perspective of an investor wanting to give the company finance in order to undertake this project. That investor is going to require a rate of return, and we want to be sure that our project delivers more than that rate of return, or at minimum that rate of return. And that's another way of thinking about a weighted average cost of capital, is that if the company has to finance, and it might finance through a combination of equity and debt, what does this project need to generate in order to satisfy the investors that are putting up the money for the project? But again, that would be some sort of forward-looking determination. You could base it on the current cost of capital for the company, or you could build in some sorts of forward-looking expectation of what that might be. Okay, do we have any additional questions? So Christine, that's also a very interesting question. So Christine is asking, if I borrow the initial 500 from the bank, will that bring up the return? Now, I would actually love to really get into capital budgeting, because it is a sort of an interesting area of corporate finance, and one that comes up often in the real world. When we borrow the money, we are now going to have to pay interest on that borrowing. And the interest on that borrowing will have two effects. One is that the cash actually has to leave our bank account each year as we pay it down. So that 300, it might not be 300 coming in. It might be 300 less the interest expense. So it could be 295, because now we've had to pay a little bit of interest. So the fact that we have financed this means that we expose ourselves to interest expense, but interest has this interesting property when it comes to kind of a corporate finance environment, because interest is what is known as tax deductible. And I don't want to sort of get too lost in the weeds of this, but essentially, when we think about our income statement, we can put our interest expense through as an expense, which reduces our profit, and with a lower profit, we pay less tax. So our interest expense provides us with a tax shield, which is why we say it is tax deductible. And then it becomes this real balancing act. And that's exactly what a kind of a corporate finance person will do, is because if we have debt on our balance sheet, so we've borrowed the money, we now have to pay interest expense, which impacts on our cash flows. It also means that our company is a little bit more leveraged. It's got a little bit more risk exposure because we have to be able to pay back that debt. So, and this is where we get into sort of the capital structure of our balance sheet, the mix between equity and debt, and how we are using our equity and debt to finance these projects. So, Christine, as a sort of a one-line answer, it's very difficult to give you yes or no. If we borrow, will that improve the return? It kind of depends. It depends on what else we're using to finance the project. It depends on the rate of interest that we have to pay, and whether our project generates essentially more than that borrowing cost, and thus enhances the value of our company as a whole. But it's an area that does become interesting. It becomes interesting to determine the optimal or the ideal mix, financing mix that sits on a balance sheet, and that's what somebody who sort of specializes in corporate finance will do. And on a project by project basis, there may be an ideal financing mix, some equity, some borrowing. Okay, I think we've probably reached the end of our questions, and thanks. There have been some really sort of deep and insightful questions this evening, which is great. It means that you're really starting to think about this material, which is fantastic. And I do hope that you are in an environment where perhaps somebody is considering an expansionary project, and you have an opportunity to even have a look at some of the schedules that are prepared by the finance department, and that starts making a little bit more sense to you, which would be really a win out of undertaking this course. So again, thanks very much everybody for listening in, and I look forward to speaking to you next week for our final module 5. Thanks a lot. Speak soon. Goodbye.